Okay, so we've been through the balance sheet, the income statement, and the statement of cash flows, and now we're down to the final financial statement. It's actually the simplest of all. It's the changes in common equity accounts between balance sheets or the statement of retained earnings. Uh, so the so for Unilate for December 31st, 2016, the retained earnings was for the beginning of the year was 260 million. They had net income of 54 million. They subtract out the dividends paid of 29 million. As a result, the retained earnings went up to 285 million. Okay, so now we're moving into ratio analysis. So there are ratio analysis ratios, financial ratios that apply to the various aspects of the firm's operations. They they're you know, counting numbers translated into relative values. They uh, they are designed to show relationships between the accounts, financial accounts within firms, between firms, uh, no matter their sizes. Of course, that's not always the case. It's very hard to compare a massive multinational corporation to a small corporation that operates uh, and in a single city or county or something of that matter. But generally, what's good for one or bad for the other is vice versa. So purpose of financial ratios analysis. So it gives you an idea how well the company is doing. Look at the ratios, and it gives us a quick view into without having to look into the financials. So uh, standardizes the numbers so we can compare those. In most cases, you want to be comparing with peers. Sometimes it's difficult to come up with peers, but some companies that are operating in the same business or industry, so forth, used to highlight weaknesses, strengths. Uh, the Provides us with an indication of the future financial health of the firm. The How well, what do we think? What do we think that the firm's future, the future holds for this firm? So this is the primary purpose for conducting ratio analysis. There are five major categories of financial ratios, and we're going to work through or talk through all of these with regard to the Unilate balance sheets. Liquidity. So, is the firm able to meet its current obligations? So, what is the likelihood the firm's going to default? Um, Asset management. Is how well is the firm using its money, using its assets? Debt management. Does the firm have the proper mix of debt and equity? So, the one thing to note here is uh, you know, debt and equity costs considerably more. Equity investors require a much greater return than do de- um, debt holders. In addition, the debt is tax deductible where uh, common stock dividends are not. So as a result, the cost of debt is much lower in absolute and effective costs. So, but we're always trying to answer the question: can a firm handle more debt? So the problem the problem with debt is paying it is not optional, whereas paying dividends to your shareholders in difficult times uh, is optional. It, it may not make the shareholders happy, but the it you know, it it not paying a dividend is not considered a default, which not paying interest on your bonds is. So next category is profitability. How do the combined effects of liquidity, asset management, and debt management impact profits? Market values. Market values give you an idea of what investors think about the future of the firm. Liquidity ratio. We have two. The first one is the current ratio, and we'll talk about that in a minute. And then quick or acid test ratio. So we'll talk about the difference between these two liquidity ratios. So again, we're asking a question: how is this firm going to be able to meet its current obligations? So can it pay its debts? So forth. So we have Unilate's current ratio. So current ratio is current assets divided by current liabilities. If you want to flip back or print out a copy of the financials, it'd probably be helpful. But these are the current assets and current liabilities are both from the balance sheet. The current assets, 465 million divided by 130 million, 3.6 times. So, we're just beginning to learn about Unilate, but we can see that the current ratio is less than the industry average. So what does that tell us? It's that the firm is not as liquid, doesn't have the ability as great an ability to pay its bills as do the average firm in its industry. So the current ratio, the quick ratio, is basically the current ratio, but we subtract out inventories. You may recall that inventories was 270 million. So it's a more stringent measure. So the example I always use with regard to the quick ratio and inventory, imagine if you're Apple and if you have a factory full of iPhone 11s, then I don't think they've released the 12 yet, but iPhone 11s, those are probably worth a whole lot more than my iPhone 6. I went in and looked at a trade-in recently on my iPhone 6, and Verizon offered me $10 for that. So anyway, so inventories aren't necessarily always liquid. It depends on what they can be. Inventory can be what's called stale. Stale inventory is inventory that's going to be hard to sell, may not be worth what it says it's worth. So we recall that inventory also went up between 2015 and 16. So Unilate's quick ratio, it's below the industry average. Another sign that Unilate has below average liquidity, below or lower than its peers. All right. We'll continue with the next lecture.